As a small business owner, we care about doing tax right and saving taxes. 3D tax planning is a must-know tax concept. You want to spend this time to learn how to save taxes correctly. The title we have today is a 3D tax planning. And the 3D tax planning is a tax concept I personally created. And I like to call it 3D for a good reason. So let's look at this chart I drew myself. And so this is my 3D thinking. So I call it 3D tax planning because when I do tax planning, I actually go through these three things in my mind for my clients. Number one, the three-dimensional thinking I have is fiscal year. What is that? Why is that has anything to do with saving taxes? Oh yeah, has a lot to do with saving taxes. The number two is accounting method. What do you mean by that? Accounting method. And why does that has anything to do with saving taxes? Oh yes, it has a lot to do with saving taxes. And then the third one is tax structures. We will never be able to finish talking tax structures, accounting method, fiscal year in great detail and in just one short hours. There is no way to do that. And I really, I will say that if you're interested in any of these parts, any dimension you don't get it, and you give us a call, and or you go onto YouTube, look at a webinar bank to see whether we have something in more detail related to that, or of course becoming our client. What's wrong with that? That's the smartest thing to do. And so now let's go through these three concepts. Before I jump into there, I want to clarify two things with you because I'm so worried about when I say, well, saving taxes, and you're thinking, oh yeah, if you save me $1,000, my tax bill should reduce by $1,000. No. Tax saving means that the number times the rate, and that's your tax dollars, that's saving. So that is not the same concept with tax credit. So I want to make sure that we clarify that. So I have two other slides. I want to explain, this is our rudimentary baseline, and I want to put that in there before we go into fiscal year, accounting method, tax structures, okay? So the first one, understand tax bracket. I said here that understand tax bracket for 1040 because when we file taxes, the only tax table, the tax bracket we use are two. Number one is 1040, that's related to personal tax return, but your S corporation, your LLC, they all go there too. They use the same tax bracket. They calculate taxes on 1040, right? But Schedule C, not Schedule C, I mean C corporation, it's different. It has a flat rate of 21%. Remember, that was changed when 2018 Job Act came out and Trump become the new president at the time. That was one thing he made changes to. So he made corporation tax a flat rate, 21%. So with that, I want to bring your attention to the tax bracket. You see, when we talk about tax saving, a lot of people were thinking about their 1040. So whatever money they paid on 1040, they're saying that, well, that is, you know, I pay less, I save taxes. If I pay more, you, tax preparer, didn't do a good job. So that's kind of what they're looking for. So now let me introduce to you about this tax bracket and this complexity of tax dollars. So for every taxpayer, like people like us, we pay a lot of taxes. And right now, here we are only talking about the federal income tax. The state has income tax too, right? Some states don't. Texas don't. Florida don't. So there's states that don't have 1040 income tax. But most of the state does. And most of the state would give you a rate range. So I use Iowa as an example. Iowa personal 1040 income tax bracket goes from 0.33% to almost 9%. Okay, so it depends on how big your income is. And any income over $73,000, you're paying the top rate. And for federal, the bracket goes from 10, 12, 22, 24, all the way, right? And so I made a chart here for you to kind of understand when they say progressive rate, when they say tax bracket, what do they mean? So now you see, I'm making $50,000 taxable income. And from 0 to $9,875, that taxed at 10%. Then from 9,875 to 40,125, it is taxed on 12%. Then up to 50, 22. So you don't say that, oh, what's your tax rate? My tax rate is 22. No, that's not right. And your effective tax rate in this case is about 18. All right. So that is how we kind of understand, okay, the more income we have, the more money we save. So let's say my top rate is 37, and then when I have my $100,000 sitting on the top, if I can reduce that down, didn't I save the rate between 37 to next bracket of 35? Right? So we want to understand that we're trying to save taxes means we are bringing ourselves down from the bracket. Okay, the lower the better, the less tax to pay. And of course, in here, I was just talking about the tax deduction, which is if you made a $50,000 income, you spend $50,000 in business, then your income is 0. So that $50,000 expenses is what we call tax deduction. It is a deducting your income, so the tax rate applies to the lesser income, you will pay less taxes. That's different from tax credit. So I ran this example for you. I found it online. It is so great. It's better than what I draw with my hand. And also, it's such a great example. So it says that if your total income is $100,000 and you have a $10,000 tax deduction, that you make your taxable income $90,000. With your rate going on, you pay $22,500 income. That's what tax deduction. This is what you reduces your income. But tax credit works this way. Tax credit says that, well, you made $100,000, go ahead and pay your taxes. So that's a $25,000. But the $10,000 is not tax deduction. It is actually tax credit. Boy, you pay so much less taxes because that's a $25,000 taxes minus $10,000. Your tax bill is only $15,000. So now you kind of goes, oh yeah, that tax credit is really good. I want that. And there's a lot of tax credit available. And that will be a great webinar I put on next time to summarize all the tax credits for people, okay? However, today, we're not talking about tax credits. Today, we're talking about that $10,000 reduces your income. How do they reduce it? We reduce it through that three-dimensional thinking. We reduce it on the fiscal year setup. We reduce it on choose of accounting method. We reduce it on the tax structure, reset, okay? So now let's go to the fiscal year. There are so many words related to this. People talk about calendar year, fiscal year, tax year, accounting year, whatever years is so confusing. And you just want to kind of shake away with all the new terminology and the new jargons that came up. And just remember that there's only two types of years that IRS is talking about. The tax authorities, whether at IRS or at the state, they're talking the same language. So there's only two types of choices. Number one, is calendar year. So calendar year is simple to understand. You run from January to December. So in January, you began your year with zero income. By the time you reach December, your income was $100,000 in total. Okay, so that is your income in the calendar year. Your expense goes the same way. In January, your expense is $10,000. February is another $10,000. March, $10,000. So you got $120,000 total expenses in the year. So you are going to account them to calculate taxable income by using the 12 months income minus 12 months expense. So that is your calendar year. Okay, that is how normally we are. Because when you file your 1040, you of course were doing from January to December because that's what the W-2 was, right? Your employer was giving you a W-2. That is your income from January to December. So now you automatically, without thinking, you are already in January to December. But there is another way to account your income that doesn't apply to sole proprietorship, does not apply to 1040 individual taxes, but I'm talking about businesses. So the business can choose a different year. That you can call it fiscal year, you can call it tax year, you can call it accounting year, but it is not a calendar year. So the year the company choose, that can be from any month to 12 months later. So you can start from February and on the next year, end of January. You can start from November 1st and end October 31st in the following year. So that's the 12 months running, okay? So you might sit here goes, oh yeah, I understand that, but what's so important about it? It is important. Let me tell you this story. And if you are in, say if you are in a business and let's say you sell Christmas novelty and in the store. And your specialty in Christmas novelty, and you know that the whole year you are going, but your sale really gonna be just good in November and December and January, am I right? So your peak season is actually in the winter. Do you want to pay taxes right when you made it? So by December 31st, you file taxes, goes, oh yeah, I made so much sales. You haven't even got time to pay your bill for the inventory you bought yet. And are you enjoying paying a lot of taxes just because you haven't really got time to deduct your expense? Your answer would be no way. No way, right? So what you really want to do is to make a seasonal business reasonable. So you want to account that season cycle. Your season cycle starts from November 1st all the way to October 31st of next year. So if that is your seasonal cycle, you can imagine that you made a lot of money in the very beginning of the year. Throughout the year, you spend all these expenses. So by the time October 31st comes, and don't you already spend most of the money you need to spend? So the profit you left is really representing the real profit for you, right? So choosing a reasonable, logical, not crazy year is a must to do for business. But do you know how many clients walk into my door with a food truck business or with some kind of business that's really seasonal, and they are really just paying taxes right when they finish the high season? And I'm sitting here goes, why are you doing that to yourself? You must be enjoying paying a lot of bills to IRS. Well, IRS loves you. You know, they will love you so much that they will make you go to the advisory committee and to advise them, okay? So you want to make sure that you look at your business and make a determination on what fiscal year you need to be. So you might say that, oh, well, now Ying, too late. You tell me that I already filed my taxes so many years with the wrong business season, and now what do I do? And no big deal. And there is changes you can file, and you can certainly make the year changes, so that way, and you can run a short year. Let's say you run January to December, now you want to change it to November to October, let's say. And you will go to file the form. Let me show you what that form is. Application to adopt, change, or retain a tax year. All right, so this is where you will come in and getting your tax year reorganized. And when you do that, and like I said, if you are going from January to December, now you suddenly think that, oh, after I hear Ying talking, sounded like I should be November to October. And then what you do is in 2020, in this year, you will file a short year from January to the end of October 31st and attach this form 1128. Then know that next year your real season will start from November 1st all the way to the end of October. So that would be something you want to sit tight, consider whether that would be something good for you. So I listed a couple of seasonal business where those kind of things should be considered. One is food truck, outdoor adventure business, like those tour lead to the jungle or to the hunting area, and they really just operate in the summer. And the lawn care, the same thing, Christmas lighting, chimney sweeping, and those are specialty retailer. Specialty retailer would be the example I gave you on the Christmas one, right? So those are the things you want to consider. And I talked about the benefit to move away from calendar year, because that will naturally contain your income and expense in the right cycle. So you are not going to be like, oh, my income is good, but my last year, my business spending was really big, so I'm still not having a good year. So you yourself couldn't even figure out what is your right business bottom line, because you're mixing up your business cycle with the wrong years to account for. So this is where that's your responsibility 100%. In my second book, Growing Your Business, I actually have a chapter to talk about just how this works and examples of many clients I meet and how they were struggling with, they could never get accounting right. They were always like, I don't really know. I feel like I have a good year, but my book says it's a bad year. And I feel like I have a bad year. My book tells me that I made a lot of money. I don't understand. Does that sound familiar? That's exactly what people say to me. Now, let's go back to my pretty drawing again. So we covered fiscal year, right? So now let's talk about accounting method. Accounting method. Okay, so first of all, accounting method is a set of rules used to determine how and when to include income and include expenses into a report. So this report could be your financial statement, and it could be your tax filing forms, but it is a method. That's why it's called accounting method. It's a method to figure out when and how this should be included. So when is very different, because when means if I paid it on January the 1st, do I include that in my last year's tax return or my financial statement, or I should include that in the new year, in the 2020? Let's say I paid that on January the 1st, 2020. So do I report that on 2019 or I report it on 2020? Depends. If you are on a cash method, because it didn't go out of your bank, so too bad, very sad. Doesn't matter how much you paid, you cannot deduct that amount. But if you are on accrual, because That's expense incurred in 2019, even though you haven't paid yet. Maybe you had a 15 days deal and you are waiting for 15 days. So it's sitting on your payable, is ready to be paid, but you already utilized it. You already used it. And then you can deduct it. See, that is in a point of expense. So if you are imagining this expense to be a big dollar amount, say if it is $100,000, don't you like that $100,000 to be your expense right now for 2019 tax return? Or you're thinking, oh yeah, I'm going to wait until next year to deduct it. Obviously, you want that to be deducted right away. So accounting method become a very important play in tax planning. Okay, the tax return requires us to report the accounting method from the day one. As soon as you open up a new tax return for a new company, that must answer question is to ask you what accounting method you are using. And you know what? Some people said, well, Ying, I don't remember they asked me that. They never asked me that. Well, of course they did, because the reason you don't know is because you great software that you use default everything on cash. So they defaulted your accounting method on cash method to save you not bother with that. But that might not be a good idea. It is not a good idea for my Christmas gift shop. Remember, I bought all this inventory in November. And then my vendor loves me so much, give me 90 days to pay. So I got in November, and I was selling in November, December, and January, and I only need to pay in February. And if I am choosing an accounting method of cash, what happens? Because I didn't pay my inventory, so your cost of goods sold is not going to be there, right? But if you're on accrual, those are your proper cost of goods sold. You just have a payable to pay. You need to pay it, even though you haven't paid it yet. So my Christmas shop really cannot afford to be classified as cash method. But if you walk into a tax preparer, doesn't have any concept of three-dimensional planning, all what they do is they open up the software, the software make it cash method. There you go, done. Damage is done. And sure, you may say that, well, I deducted it anyway, I don't care. Oh yeah, you would care when you get audited, because that's the first thing the auditor will look. Auditor will look at what method you are on to decide what expenses to allow. So those are important items to really understand. You got to plan. So now I said that there's just two basic ones, right? Cash method, accrual method. And you understand when you choose accrual method, let's say you're a dental office and you got a lot of insurance claim goes up, and you submit $185 to pay back, and the insurance company, God knows what happened, because your patient have different kind of insurance policy. So the income you got was not 185, it's actually 105. You're short of $80. But on your book, you accrue that income for 185. Because when you submit, you think you're going to get it. So you will have accrued income for 185, but you're going to get 105. Okay. So you constantly have to make that adjustment to adjust the amount you didn't receive. That's a lot of accounting and a lot of senior accountants accounting, right? So dental offices, and most of the dental offices in my experience, they're normally not cash poor. They're running pretty good with cash flow. So on expenses side, most of the dental office, they would pay expenses right away. They pay expenses right away. And I have a, I need to open this door for the puppy because he keep on yawning. Peanut, I don't like you because I'm on the webinar and you really screw me up. I'm so sorry. All right. So the dental office normally have their expenses pretty well organized. right? They pay it when they got it. So if you are in that kind of lifestyle, what's the reason to be on accrual? You don't want to accrue that income so inaccurate and making you do all these sophisticated accounting adjustments. You want to be on cash. So when you are on cash, what happens? And whatever you deposit into your bank, that's your income. Whatever is not deposit, that comes later. So I will deposit that, I will account that later, right? And then what about your expense? Expense gonna come, and you might say that, oh, Ying, what if I purchase a big equipment? I thought when you purchase big equipment, you actually will loan money, right? You will pay down, you will loan, that whole asset gonna sit on your book, and that will be depreciated through your expense line. That doesn't really have a lot to do with accounting method. Okay, as long as you're loaned it, as long as you had a down pay and you paid it, and that deposit was coming in, the equipment was purchased in this year. So again, and there's a lot of things that you can consider on the accounting method, and don't take it lightly. And if you just started business, make sure you consult on what accounting method you should be, what fiscal year you should be. Don't rush into setting up a company and without even thinking about them, because those are the information IRS wanted already when you apply. Remember when you apply for a new company, the EIN application form would ask you your year end. So that is the intention, wanting to nail down your fiscal year. Then in that form, it didn't have accounting method, but on your first tax return, it has accounting method for you to determine. So those are the things really important, and should not take it lightly. This is our three-dimensional views that I am trying to have you visualize that, so you can see what I am talking about. Then now let's look at the tax saving. From tax saving standpoint, the benefit of cash method. The tax saving on cash method, and this is really straightforward. And for a small business owner, you literally use your bank statement. You would figure out how much money you made, what expenses went out, what income came in. So that really offers a very easy accounting, the deduction very clear, okay? And if anything outside of your bank statement, sorry, it didn't exist. If it is on your credit card and you didn't pay it, sorry, it didn't exist, okay? That's cash method. Then benefit on accrual method, it is also that income you accrue. So for example, on my Christmas gift shop, I don't mind to accrue income. I literally don't have any customer tell me that, oh, I'm going to order $50,000 worth merchandise from you, and you know that I'm going to pay you in 30 days. So you normally in the retail, you normally don't have those kind of accrual of accounting needs, because accrue income needs, because your income comes when it comes. It doesn't really, you don't, not like dental office, you bill that income and it would come in with a different number, right? So in the retail, you're accounting for deposit and income, even though you deploy accrual method, but you literally is a cash method. Am I right? By fact. But you choose accrual, but by fact, you are a cash method. But expenses is different, because you choose accrual, so you're gonna have expenses that you can deduct even before that really got paid, right? And a certain industry will be more beneficial to be on accrual. So you know that when you are getting into a business, and now you know to think about what accounting method you want to choose. And if it is a business that can choose both ways, maybe you choose accounting method based on your current needs. So in the very beginning, let's say in the very beginning, and you don't think that your business is gonna go really well, you're gonna have a lot of loss, and you don't want your accounting to look so bad with all these losses, and then maybe you are on cash. So whatever you spent, that loss you document, and you don't have to stretch out to more losses from next year into this year, right? So then later on, when you decided I'm ready to change accounting method, do you know that you can? Okay, you can change it, especially if your tax return has already been filed and your tax preparer had never ever even mentioned to you about this, and you're just waking up to the fact today, and then you want to go back to look at what you did. If that is wrong, and you know that you can change it, you can change your accounting method and using two different forms. And I actually had already I laid it out here, so I will show you on my screen. Okay, so that is my second point for the three-dimensional tax concept, and I want you to keep that in mind. And I really think the fiscal year should sink in with you really well, and you understand. An accounting method might get a little tricky, but just keep one thing in mind. It is not about you fix one accounting method and it could never change again, you're stuck. It is about you realizing you need, then you can plan that accordingly. Okay, and now let's go to my website, and I want to show you the two forms that IRS needed to change accounting method. Remember I mentioned to you earlier, the accounting method is actually one of the accounting methods for sole proprietors and 1040, that those are always on cash, you cannot change. Okay, so I take it back. So proprietor you can change too. The only accounting method you cannot change is actually 1040, your personal. So you cannot change your personal income to accrual. You cannot be like, oh yeah, next year I'm gonna make more money, so I'm going to put that in this year. No, your personal is always on cash. But when you want to change accounting method to another method other than cash, accrual, and you would fill up this form 8716. You see this one? This one is to election to have a tax year other than a required tax year. So what does that mean? Because some of the pass-through entity, for example, S corporation and LLC, when you file taxes, and you realize that because the K1 is passing on to your 1040, so majority of the S corporation LLC would line up with the 1040, go for from January to December. But in some cases, with the seasonal business reasons, and they don't have to be, when you need to stay away, when you need to move away from the January to December and choose a different tax year on the pass-through entities, you need 8716. But when you are just choosing the method because it was wrong, then you use 1128. So those are the forms available to you that you can use. And I want to show you what it looked like, so at least when you get into those ones, and you will recognize them. So now let's go to our last one, right? And aren't you excited? We're already into the last one. Okay. I'm coming back to my pretty drawing. Now we talked about fiscal year, we talked about accounting method and tax structures. This is really a place where probably I would say by itself is a 2-hour classes to really go through them. But I drew some chart for you. I have a very simple ways to explain it with example. So I hope that resonate with you and trigger you to think, because my whole purpose is that to give you the knowledge today so you can ask meaningful questions and you can rethink of what you're doing under the three-dimensional tax concept, and then start looking to change it in 2020. I'll tell you, 2020 is such a good way to make changes for your taxes, and not only because most of the businesses are slowing down somewhat compared to last year. And how do you use your slowdown time? Are you going to add value to your slowdown time, or you are going to just waste it? I say you add value. How do you add value? And understand more. Understand things you never want to spend time for. And understand the three-dimensional thinking that I am introducing to you. Now, I have an even worse drawing here for you, but I want you to kind of follow me because I really think this tells it all, okay? Now, the most common structures for small businesses are these 5. Sole proprietorship, LLC, S Corp, C Corp, and non-profit. Okay, not-for-profit. Let me go to not-for-profit first. And I want to correct a concept out there because I have seen too many people and they run a business. Then the business is not really making, and the business is not making money. So our business owner start thinking that, well, then I'm running a nonprofit. Why? Because my business doesn't make money. So not-for-profit is not to say your business don't make money, so you qualify for it. Not-for-profit means none of your taxes, none of your profit is going to pay taxes. It's going to pay income taxes. So not-for-profit is not about to say you don't make money. It is to say none of your profit is going to pay any income taxes. So it is a special status you need to get. So that is an application. The form number is 1023 and 1024. Okay, that was covered under my webinar related to nonprofit. I had one this Tuesday. So if you go onto our YouTube, you will see that webinar. So I covered over there. And with that, and you will know that you have to be one of the entities on the list. Your LLC or your S Corp or your a C Corp and not sole proprietor. But if you are one of those entities, you can elect yourself. You can elect yourself, apply for a exemption of income tax. So that process will make you a nonprofit. So having said that, so our small business owners, and don't try to move your business to not-for-profit unless your purpose is that, well, I made a lot of money, but all of this money I consider and should not pay taxes because it is for common good. I have this business, but I really charge people and benefiting the community. I like that to be non-taxable, so I can give it all back to the community. That is when you do nonprofit. Otherwise, you just have a business issue. You have a business and you're not making it. We need to figure out why. I just hope that my book has come out quickly enough that for those people to understand how to grow your business. Okay, then now let's talk about my chart. If you look at this chart I wrote here, I want you to see the right hand one. That's a bigger box I marked as 1040. Did you see that? So inside of the 1040, I have a Schedule C, I have a LLC. Inside of the 1040. These are the ones we call them disregarded entity. All right, so that LLC is disregarded because it is a single member LLC, so it is treated just like Schedule C. So that's your sole proprietorship. Okay, so it is included in 1040. So when you think of anything related to this business, for example, if I have a restaurant, but I operate the restaurant under my name, and I use my social security number to apply for sales tax ID, to pay my folks, and I use my social security number, applied for a EIN number for sole proprietorship, I run payroll. All of that doing is inside of the 1040. So this is a structure. And folks, I want you to know that when I sit myself inside of 1040, the idea is that I am the one working and I'm the one sweating, so I am the one doing the work, right? I'm sole proprietor. When I do the work, I should pay self-employment tax. That is equivalent to Social Security Medicare for employer and employee portion. So that's round up to 15%. So when you are inside of 1040, as long as you work your work, you spend your time, you sweat on it, and you do the work. And sure, tax return is simple because you only file one tax return. You finish your business and you also finish your personal. So that way, yes, it's simple, but you are paying income tax plus self-employment tax. So if your income tax is 20%, remember we have this tax bracket. Doesn't matter which bracket you are on, you add on a 15% on it. So that would be your total taxes. So if you have, I have a client with a Schedule C for $6 million profit. 6 million, yes. They leave themselves on Schedule C because they don't know any better. So they overpay taxes on self-employment side. Of course, there is a limit for how much they charge for 15%, but leaving the complexity out, the reality is that they overpaid self-employment tax. For someone makes $6 million profit, not all by himself, with some employees, that should have been moved out to be the other entity. Could be a C Corp, could be an S Corp, and it should never be there for that long. Okay, so this is where the sole proprietorship come in. So I explain this to you, just want you to make a mental note, knowing that, okay, you know, there is a self-employment tax coming with it. So the tax rate generally inside of sole proprietorship is actually high. And if you are a LLC, but you are just one member, you are treated just like Schedule C, same, okay? There is another entity kind. Instead of a sole proprietorship is LLC. And see, I have marked LLC box on the left, and I wrote down multi-member LLC. The reason I wrote that down because in this case, they are partnership, right? Because they have more than one owner, so they cannot become a Schedule C anymore. They have to file tax return that's called 1065. And I have this little dot arrow goes up in the sky, and it says S Corp and the C Corp. You know what I mean by that? I meant to say that the LLC here can change to S Corp, C Corp through election. Yeah, through election. I just want you to remember that because you are not stuck in one type of entity. You can change. So there is a 5-year rule to apply. It's literally like when you get married, you can divorce. But the IRS says that if you want to divorce with LLC kind of entity, and you become another one, you can't be back and forth so often. We limited that to 5 years. So you elect to be one entity, you stay put for 5 years. So those are the rules, the detailed rules we can, find out when you know what exactly you need. But I want you to just understand these structures are not set in stone. You can elect them to be different. So look at the S Corp. I have this little arrows pointing out to the sky. That means it can be elected. And the C Corp can be elected. So everybody can change. Now, I want you to understand these structures, how they play out. You notice that the C Corp was kind of under the waterline, right? And so I have this little dotted line connected to C Corp from your 1040. And I wrote down W-2 and the 1099 dividend. What I meant by saying is the only connection between you and the C Corp is two, W-2 and 1099 dividend. W-2 means the C Corp may be hiring you as an employee, and then you got W-2. Of course, you're going to report that on 1040. And the C Corp might be distributing dividend, so you got the dividend and you report on 1040. And you got a dividends from your investment to Microsoft, didn't you? So that is a C Corp, and they give you a dividend. So you report that on your tax return. So you see, there's no direct relationship between the C Corp and your 1040. And the C Corp pays taxes on its own. And the three on the top, they pay the same tax bracket. They have the same progressive tax rate sheet, but C Corp just flat rate, right? We talked about that. So now with S Corp and LLC, you see I marked a K1 in there. That K1 is literally empty out everything inside of LLC to go into 1040. So let's say my partnership lose $5 million. I'm sorry, your $5 million will be going into your personal tax return as K1. So the S Corp and LLC are literally, you can imagine them to be a bucket with no bottom. So what goes in, what comes out, and it does go through some changes, the deduction, and $1 million comes in, $2 million spending, so got a negative 1 million, K1 negative. All right, same thing with S Corp. So this is where we call them pass-through entity. They're passing through their own corporation structure to your 1040. So now when we do tax planning, do I allow you to file your S corporation first? And then goes, oh yeah, I already filed your S corporation. You made $1 million and you have to report that $1 million. Now you don't want it because you didn't think you have it. That's too late. So I know a lot of practice, what they do is it's too much work for them to hold on to the S corporation, finish your 1040, then compare them, looking at them before filing them together. And it's a lot of work, but in my firm, I'll tell you, for 20-some years practice, we do not allow any of our staff to file your return of S Corp or LLC without finishing your 1040. And we may not file it, but we're done. And if you don't let us do 1040 and you want us to S Corp, and we always tell you that we can produce some really awful result on S Corp, and you think is a company tax return has no relation to you, that's not true because it's gonna all be reflected on 1040. And some people goes, oh, well, Ying, that's not true. I had a negative 1040, I had a negative K1 coming to me, and I could not deduct any of them. My 1040, my tax preparer said to me that, no way, you cannot deduct it. So I wasted. You know why? Because the K1 has what we call the base calculation. So it's almost like if you lose $5, but you never put in $5 to begin with, that loss of $5 is not your loss. So they don't allow you to deduct it. You have no base. So when we have people with negative K1, we study their base sheet carefully. A lot of time we realize that those years they're working on their own, or they're working with some other, preparers. The base was never ever even calculated. And you don't realize the problem until you have a negative K1, but you cannot deduct it. So this is where all of these talk I gave you related to structure, I just want you to close your eyes, realize C corporation doesn't have a lot of connection with your 1040. They have W-2 1099 dividend at most. And people don't have to even issue 1099 dividend. So the most is W-2. You don't even have to issue W-2. Then you have no connection to C Corp. But your LLC 1065, 1120S, and they have connection to you. They will dump their annual result to you. So that would be something we want you to realize. So when you plan your taxes, and you keep in mind which corporation, which business need to be part of the planning. All right. Now, let's look at an example. And this is an example about a business. This is a real estate business. It's a real estate agent, and she also have a rental properties going on. And she also does house flipping on the side. So this is her tax return, okay? So on 1040, she has a W-2 that she issued to herself from the commission that she made from the real estate company. Keller Williams is the company that paid a commission to her, $300,000. So $150,000 is the W-2. So from that 1120S, they have a $300,000 real estate commission income, and they also have $200,000 rental income. So that made up the 1120S. But the rental income, the rental property are not part of 1120S. They were put under LLC to be a title holding company. There's no activity, just holding titles and depreciate the properties, and the owner of that property of the LLC is husband and wife, so it's a partnership. So the only income they're getting is from 1120S, and so 1120S will pay to them for using their properties to rent, right? You can't get that for free. You cannot be taking my house and rent it out and I'm getting nothing. No. So the LLC would get paid for letting them to use the property. You can call it a rent. Then the LLC has a mortgage payment, depreciation, insurance. That's it. So you have the LLC. The result goes to the personal tax return as a K1 for 1065. The 1120S hosts a commission income and dealing with tenants, and all of their clients knows about this beautiful name of the company, but no clients would have anything to do with the title holding company. So the risk is retained. If one of your tenants break their leg because climbing your stairs and sue you for a couple $1 million, and what can they do? This management company doesn't even have any asset. The most you can do is file bankruptcy and pay whatever you need to pay, and hopefully your insurance is backing you up so you don't have to pay, right? So that is the 1120S. Then remember, she also does house flipping. So the house flipping, and she always, in the summer, she's very busy. She's very busy with clients, showing house and buying houses. So she really just do the house flipping in the winter. She identify a house sometimes maybe in the fall. And then the winter months, November, December, January, and she would really do the renovation and get the house ready. So the spring comes, April and May and June, and she'll work on selling that house. So with that special seasoning, a seasonal business, And so she starts from November 1st as the beginning of the year. And this November, I put it December, I put it wrong. It's supposed to be October for the end of the year. So she already spent a lot of money from November, December, January. Then let's say she sold it. And then after she sold it, and if there's any other repairs or whatever need to be done, by the end of October, that one deal had come through a real good cycle, don't you think? So that way, she doesn't end up paying taxes on the sales price because she hasn't really finished the house yet. So this is a real life example. Then you can see why people are having different tax structures. And I'll see you next time. Bye-bye. I love you all. Bye.